The tide continues to shift on shares of Snap Incorporated, days after its splashy initial public offering. Shares of Snap Incorporated, Snap, -12.26% fell more than 12% on Monday, reversing two straight sessions of upswings since its market debut. The sell-off followed two more bearish initiations on Wall Street, adding to several others that have emerged in the past few days claiming the stock is overvalued. Needham analyst Lori Martin initiated coverage on the stock with an underperform rating, which is the equivalent of sell, and a fair value price target range of $19 to $23 a share. She expressed concern that Snap stock could suffer through at least 2019, plagued by decelerating user growth and huge losses that could weigh on its fair value even if sales increase. The sexier and more glamorous a company's IPO, the more likely it is to be overpriced at its IPO date and to suffer meaningful downwards earnings and valuation revisions in the first 8 quarters after it goes public, said Martin, citing academic literature. CFRA research analyst Scott Kessler initiated coverage with a sell rating and $22 target. A number of analysts in recent days have expressed concern that Snap stock is overvalued, particularly when it was trading well above its IPO price in the high $20s range. The average rating on the stock among a poll of 6 analysts surveyed by FactSet is the equivalent to sell, while the average price target is $16.50, below Snap's IPO price. Snap stock closed at $27.09 on Friday after pricing in its market debut at $17 the day earlier. It ended at $23.77 on Monday. In a note to clients that went out Monday morning, Needham's Martin referred to Snap as a lottery-like stock, which at first glance may look like a good buy. However, closer scrutiny of its fundamentals reveal a different story plagued with risks, she said. Among those risks is slowing user growth, which is exacerbated by the fact that Snapchat has a total addressable market that is 80% smaller than Facebook Incorporated, ZFB, plus 0.18% according to Needham's calculations. Facebook, which recently rolled out a Snapchat-like ephemeral photo-sharing service called Instagram Stories, offered to buy Snapchat in 2013 for $3 billion. Its rival Snapchat service, launched this past summer, has been credited for a deceleration in Snapchat's user base. We see strong user engagement, but user growth that has decelerated, said Kessler, who cited similar reasons for his sell rating. Revenue gains may be outpacing peers right now, but it faces much larger rivals, which becomes an issue as it tries to scale beyond a niche product, he said. Snapchat's revenue growth might also be an issue. The company reported revenue of $463.1 million last year, up sharply from just $58.6 million in 2015 as it continued to increase its ad load. However, Needham's 2017 revenue target of $3 billion for 2019 would require the company to have a 14% to 16% share of adjusted mobile or digital ad spending, while it had just a 2% share in 2016. Even if Snap does grow revenue by 8-fold to meet that target, its share price could still decline when taking into account the enterprise value, sales ratios of digital advertising leaders Facebook and Alphabet Incorporated. Google, -0.21%. Google, -0.16%, said Martin. Needham also believes there's no clear path to profitability before 2020. Last year, Snap reported a loss of $514.6 million, compared with $372.9 million in 2015, which stemmed from higher costs of revenue. Snapchat, which has been referring to itself as a camera company in an effort to distance itself from its social media peers, was joined in Monday's sea of red by GoPro Incorporated. GPRO, -7.92%. Shares of GoPro, a camera company that often refers to itself as a media company, closed down 7.9% to $8.14 following a downgrade from Goldman Sachs.